Now let's check in on the currency markets now, and billionaire Warren Buffett says the U.S. dollar is under threat, and this as the U.S. continues to pump billions to try to bail out its banks and its economy. Meantime, George Soros says the dollar is not the sole reserve currency anymore. So what should you do? Well, PIMCO's Bill Gross manages the world's biggest bond fund, and he recommends that investors diversify their currency exposure. And surprise, surprise, so do other investors.
Maybe in 20 or 30 years, my US dollar component may be down to 10%, and my renminbi component may be up to 40%. That's how I would dynamically adjust my portfolio going forward. But right now, at this point in time, I think the US dollar is still going to be the central anchor of my currency portfolio.
That's right. The dollar is here to stay, at least for the next 5 to 10 years, according to analysts. Dollar-denominated markets like treasuries are the largest, also the most actively traded in the world. And analysts say that alternatives from gold to the euro just aren't yet as viable. So what's the upshot? Well, HSBC Private Bank and also Barclays Capital says buy Asian investments. And that's because the region's governments will have to restructure their economies, moving from mainly export growth to more of a consumption model.
Current account surpluses will come down. That imbalance pressure will ease. Now, what does that do for asset markets? I think what it does is it drives up the value of assets within this region. And so we see further rises in property prices, further rises in construction companies' share prices, those sorts of asset classes. So Asian assets should do relatively well.
HSBC also recommends U.S. and European companies that stand to benefit from this growing demand in China and Asia to pick out stocks like the likes of Caterpillar, Carrefour, also Procter & Gamble.